So I know you're really an expert on the housing market, but I do have to ask you a question about some of this tariff concern when it comes to these home builder stocks. I'm looking at what the NAHB, the National Association of Home Builders, put out. They said about a third of appliances and a third of softwood lumber, just under a third, comes from outside the U.S. Softwood lumber, by the way, for people that don't know, it's like fir, spruce, pine, et cetera. Why can't these home builders, why can't they just replace their source here in the U.S. and reduce some of this issue?
Really have like the sawmills and the setup to deliver as much lumber in this country now currently. And when we think about the builder survey, that's tilted to smaller builders. They don't have the corporate profit margins as the bigger publicly traded builders do. So on top of higher rates, if you add tariffs into the mix, we're going to get a hit on margins, especially for the smaller builders. I think that was the issue in the survey yesterday. But if mortgage rates were down at 6%, I think this issue with the builders comes a little bit lower in terms of stress. However, higher mortgage rates, higher supply, especially in the South, and then you add tariffs onto the mix. No, I think the builders survey going out 6 months has collapsed in the last 2 months in one of the faster fashions we've seen in the last 20 years.
So what is going on with the mortgage market? I was just looking at Mortgage News Daily. We're showing their stats right here. Back in September, rates were pretty close to 6%, about 6.25%. Now we're back above 7%. What is going on? We had the Fed cut rates. A lot of people are expecting more rates coming up, more rate cuts, I should say, coming up later this year. Do you think that's going to be the cure for what we're seeing in the housing market?
We had about a 2% move from the peak with no rate cuts, and then the economic data started to get better. Fed policy, if we're looking at it for housing, is still very restrictive. The market was anticipating weaker economic data. It didn't get it. Once the data started to firm up, bond yields went up. That's actually pretty normal. To me, either the labor market has to break, or you need about 1% more of rate cuts to kind of get that trend lower to maybe get down to 6% easier. We've only seen the housing data start to improve when mortgage rates get down towards 6%, but the labor market isn't breaking, it's getting softer. So currently right now, the housing market still, we're going into the 4th year of the lowest home sales ever when you adjust it to the workforce. The builders, though, have a different problem. Supply is rising, especially in the South. If you don't have the high corporate profit margins, you can't pay down the rates. So it's more problematic for them this year than I would say the last 2 years.
You know, Logan, it's interesting. So you're saying if we see continued weakness in the job market, that's going to somehow help the housing market. But we just heard from one of the home builders, one of the issues is affordability on the low end. So if we see weakness in the housing market, isn't it just going to impact that low-end consumer even more?
It's over 162 million people working. When mortgage rates go lower, the people that traditionally buy homes tend to be more employed than those that don't. So the rate variable matters more. And we saw that during COVID. There's 20 to 30 million people unemployed. There's 5 million in forbearance mortgage rates. As soon as people thought they're going to be living again, the rate variable, even with 30 million people off the grid, demand picked up like this. So we're at record low levels of sales in the existing home sales market. However, the new home sales market is still at 2019 levels, so it has a little bit of a higher bar to work with. But when I think about the new home sales sector, it typically does better when rates are at 6%, because if the builders do need to pay down rates, as they have to make rates sub 6%, they can do that, where the existing home sales doesn't. The tariff issue, again, is just another layer of concern going into 2025.
All right, so coming up today, we get housing starts and building permits data. Friday, we get existing home sales number. What are you expecting when it comes to those reports? What do you see the impact being specifically to the stocks and sentiment in the industry?
I think you have to look at where housing permits are going, especially single-family permits going out for the next 12 months. Typically, when the builder survey starts to get weaker, single-family permits tend to fall. They had been picking up when rates fell last year. So that's something to keep an eye out, especially for the rest of this year. We're finishing a lot of projects that we started 2 years ago for the housing starts data. The existing home sales report will be down just a tad month to month. Again, record low levels of sales. We're not going anywhere in that marketplace. So keep an eye on permits and the units completed. I think that's going to be the story for 2025, because every economic cycle we've seen outside of COVID, residential construction workers tend to lose their jobs first before the recession. The employment levels are still very elevated for the construction workers. That's the wild card for me in 2025.